welcome back to Give Me Some Truth. And in the beginning of the year, it's always fun because it's the beginning of the year, but also because looking forward, we can talk about some of the thoughts on the horizon and highlight our Walkner Condon 2024 Outlook piece. So Keith and I are in the booth. I'm Mitch. And it's been a while since Keith and I have been in the booth. This is kind of a cross-border interaction.
Yeah, kind of unique, especially, part of it is my piece was more domestic-leaning than it's been in the past, I would say, but also just because, the U.S. market dominates the conversation across the world. And when you talk about the U.S. market, the old axiom is when the U.S. sneezes, the world catches a cold. So, it's one of those cases where we're talking about, I think, very similar things, so it makes sense. And, I think the last couple of times it's been ESG, which, again, has global ramifications and so on and so forth. So, makes sense that we're here together today.
Yeah. I'm glad to be back with you.
It is
kind of fun.
Yeah, it's a throwback.
It's a throwback.
A little nostalgia.
Yeah. Kind of like Back to the Future.
Indeed.
Throwback.
Speaking of Back to the Future, 1986, very close to the last time your beloved Lions won a playoff game. So
my beloved Lions, yes, they won a playoff game for the second time in my life, basically. So, I am younger. I'm in my 30s, but yes, that is how few victories the Lions have. In the last 3+ decades.
And so we are, truly going back to the future in that way, I suppose.
Yes, and Michigan won the national championship.
I know.
What is happening? I pinch myself daily.
The 1986 Bo Schembechler era. Now, our theme is Back to the Future, and I think, both of us kind of, when we got into things, looking at the two things that we're talking about, and in Mitch's case, talking more about what has been called the soft landing, and on my side, the traditional approach and what really came out in the 80s, and that's part of the reason why we're kind of going back to the future, was in order to fight inflation, you had to basically raise interest rates to such a level that you created a recession. And one of the debates going in to kind of, 2021 into 2022, where we really saw inflation and the Fed really kind of push the lever, push the pedal to the floor, to use the DeLorean metaphor, in terms of reducing inflation. What a lot of people thought was it was going to be a repeat of the 80s. And, what happened in the 80s? Well, so we had about, and one of the things that, people misunderstand or misunderstood, we had basically a decade of inflation going into the late 1970s. Richard Nixon, in order to keep unemployment low in advance of his re-election, actually pushed for higher inflation because he believed, there's a long-standing belief that there's a relationship between inflation and employment, that inflation is a result of a faster-moving economy, and a faster-moving economy means lower unemployment. And so that started early in the 70s. And so you had, by the late 1970s, the chair of the Federal Reserve, Paul Volcker, basically was like, in order to get rid of this long-standing inflation, and it, was not, we're not talking hyperinflation. We're not talking Germany in the 1920s. We have to basically raise interest rates, slow the economy down, and eventually, as, Mitch and I, very similar kind of age, if you are our age or if you're our parents' age, they will tell you about their first mortgage that they got because the Federal Reserve had raised interest rates to 13 or 14% in an effort to kind of, slow down inflation. And
none of them feel bad for the interest rates that we're seeing now.
Yeah, it's really hard
on our mortgages when they hear a millennial or someone younger than that complain about the current mortgage interest rate environment.
Yep.
But
And
that could be a whole other tangent.
Yeah, 7.5 compared to 17.5. And with the housing market, one thing that people often lose sight of, by the way, tangent, is that
Give me some truth.
Yeah. Housing prices don't necessarily just drop like the stock market when you see interest rates go up. They tend to decline slower over time. And so what you may see is, and during COVID, we had huge housing cost spikes. Housing costs went up quite a bit. What you'll see is not necessarily a rapid increase in prices, but a moderating of those increases, and maybe even they'll stay flat for a while as interest rates, push things down and so on and so forth. So, and then the other problem we have is, people who locked in low interest rate mortgages don't necessarily want to give them up to move to a 7.5%, because the way, a lot of people work is thinking about what's my monthly payment on my house. Tangent aside. So what, the prediction was essentially was, well, if the Fed raises interest rate to bring down inflation, we're going to have a recession. What then is a soft landing, Mitch?
Yeah, so the hard landing is what you described, right? So we'll kind of define soft and hard. The hard landing is, boom, rates increase, causes recession, right, in a simplified way. And in my piece, I also talk about the soft landing is not that, right? Essentially, hey, we're able to tame inflation, and then the landing is referring to kind of the health of the economy, the landing into something where you don't kill and crush the economy. And, inflation is at a I'll say, reasonable rate. The Fed might define that differently than others, but, their target is around 2%. And then the other piece is maximum employment, right? So if that's around 4%, then that's considered, hey, we're an economy that is humming along. It's never going to be, everyone working all at once, but 4% is kind of considered that maximum employment base, if 4% is unemployed. So, knowing those two things, if there's a couple of measures that they have in place that can be used to define that's one way to look at a soft landing. And then one of the studies I referenced quite a bit in my piece, a gentleman named Blinder, who was he at Princeton or Harvard?
Alan Blinder was at Princeton.
Princeton.
Yep. Worked on the Federal Reserve. And
Yep. And he was a vice chair, and he did a study over several decades from 65 to 2022. And in that period of time, there were 11 different periods of time where we saw this inflation start to rise. What was the response? Tightening, raising rates, and then the outcome, right, is the landing that we're talking about. So is the landing hard, soft, but then, oh, by the way, I'll enter another little definition here, soft-ish. Which
like
is,
a true academic, you got to make sure you get more terms in there. I can relate,
Soft-ish, and that's kind of in between, right? Well, that's where the piece gets interesting, and we don't need to get into actually, we're not in this podcast, and I didn't even in my article get into all 11. If you want to research all 11, go read Blinder's piece. But I highlighted
which
a
is
few
linked
of those,
to in the article,
which is also linked in the article. But the conclusion is that out of those 11, there were 5 soft or soft-ish landings. So, soft-ish, instead of just saying that's kind of between soft and hard, which it kind of is. It's one of those where in some cases they may have gotten it under control, and then it may have been a healthy economy, but then at sometimes later we'd actually see kind of a reemergence of inflation, and then they might actually deem that a new period of tightening after the fact. So it's kind of like, okay, we didn't really see a crash in the economy. We didn't see a recession or a depression or anything like that. But it was kind of ho-hum, and then we may have seen inflation creep back in, and then all of a sudden we're entering a new tightening cycle.
And I think, in my piece, and kind of playing off of the Back to the Future theme, we go back to 1986, right? And 1986, 85, 84, 85, is when you started seeing kind of inflation under control. Basically in the United States in the early 1980s, you had what was called a double dip recession. We had a recession and they kind of paused, and then we saw inflation come up again, and so they, again raised interest rates on from the Fed and caused another recession. And then finally by 84, 85, inflation had come under control. And in fact, the Fed started lowering rates from that very high. And so you can look at, the jumps in that piece. And one thing that I think is important for understanding my piece is that more than even just lowering rates, a big part of what you saw was volatility in interest rates. You saw the top and the bottom within a year being pretty far apart. And, last year we saw a lot of, raising of rates. We also saw just huge swings within it. And in the, mid 80s, as you got later into, the late 80s, there was lowering, there was softening. But then what hit was, oh boy, inflation is creeping back up in the late 80s. And so the Fed responded again by essentially tightening. And, a lot of people believe that the kind of recession of 1990, 1991 helped, make George Herbert Walker Bush a one-term president because, you had the tightening of the interest rates, the economy slowed down in 1991, and, a poor economy is not great for an incumbent president. And so that has also colored a lot of the political analysis that we've seen. But I think that period in the 1980s where you saw tightening, we loosened up, inflation's back, really kind of speaks to what you're talking about, where you have the new tightening, softish tightening cycle, and I think it does speak to the fact that one of the things that people were really worried about when we saw inflation, which we hadn't seen levels like that since the early 80s, was, oh my goodness, this is going to be a long battle and a tough battle to get through.
Yeah, for sure. And the other thing that we haven't talked about so far in this podcast too is just completely external factors, right? It's not like the Fed is the only one that is going to influence these. We talk about supply shocks and war, right? Like that's actually one of the things that in some of these different cycles where, at the end of the 80s, Iraq invaded Kuwait, Gulf War, supply shock, and, the price of oil and things gets out of hand for a while. And similarly, more recently in 2021, 22, right, we saw some shocks throughout the global economy as well. And that's going to play a part in this whole inflation discussion. And that, the Fed can't control those things.
Yep.
So.
And in the late 1970s, one of the things you saw as well. By the way, when we say tightening, just to be clear, we're talking about raising interest rates. And to step all the way back, and hopefully you haven't tuned us off because we're, just speaking in jargon here. But, one of the ways that the Federal Reserve regulates the money supply circulating in the economy is by making it more expensive to borrow. And the way they do that is basically increase the Federal Reserve funds rate, which is the rate that banks get when they basically put money with the Federal Reserve. And that's like, the safest place to kind of put money. And what that means is then, if we're getting that for just giving it to the Fed, what are we going to do for loans? Well, we're going to have to raise the interest rates to 8% if we're going to loan it out on the street rather than, to the overnight window, essentially. And so you see between a 2 and 3% gap between those. It's something that fluctuates over time. Banks may need to do it more because, they've lent out so much money at lower interest rates, and so, they need to cover some of that. But, you look at that. Well, and the same goes for business loans and so on. And so when a business is thinking about expanding and they're running their profit, right, they look at, okay, should we build this new factory, or, do these if we need a loan, should we build this new factory? Well, at 8% interest, it doesn't make as much sense as it did at 4 or 5% interest. And so that is what slows things down in terms of the economy. And so, that's just one thing to kind of keep in mind when we talk about tightening or loosening, lowering interest rates, making money more available, right? And so, what you had was in the 1970s another supply shock, right? And OPEC restricted the price of oil, and that caused prices to go up. And, so there are a lot, I guess the point I'm making is there are a lot of, like you said, a lot of factors, and thinking soft, inflation being hard to get rid of, shaped a lot of this thinking.
Yeah. And another thought I had just on this whole softish piece, because one of the questions that was posed in this article that Blinder wrote that I mentioned was there a landing at all, right, for some of these softest landings? So I think of like an aircraft carrier, and there's an aircraft coming into land, right? How many movies have we seen or videos on YouTube or whatever where it comes in, it kind of maybe hits the deck, but then it doesn't quite catch, and then it kind of it goes right off the end of the aircraft carrier again and flies, and let's try it over again.
Yep. Well, in another 1986 movie, Top Gun, right?
Boom. Exactly. There you go. Perfect.
Back to the Future, there was a sequel, 2 years ago? So
right. So, you kind of think of that like, was there a landing at all? And not quite, the hard ones you surely know and feel.
Yep.
It seems like. And to transition a little bit from, because I have no idea how we're doing on timing, but, we talk a little bit about the historical context here. We talked about the 70s, 80s, a little bit of the 90s, and there's some similarities between some of these rate hike cycles. And it's like, what can we learn about from those, applying to today, similarities, differences, but then going forward? And some people seem to think, yeah, we've landed. It's soft. Well, let's continue to watch the data. Let's not get too greedy. Let's not declare victory quite yet. I surely don't think the Fed is declaring victory.
Yeah, and I think that's one of the important things. I think that may be the most important lesson that we can take from the Fed as opposed to maybe the markets, right? Mm-hmm. And in late December, when basically the Federal Reserve made their announcement they weren't raising interest rates, one of the responses was we saw, the old, what's called the Santa Claus rally, right? Where stocks take off into Christmas, and there was a, sense that, things are going, the right way. One thing we should also note, we'll come back to it, but, things are going the right way. And I think, what we have to keep in mind is just looking back to the 1980s, and hopefully, something that's come out of this from us, is every time is unique, right?
Yes.
The 1980s were their own unique piece. The 1980s were not, the inflation was not related to, as you had mentioned, a global pandemic, right? We did have an oil shock with, Russia invading Ukraine. So that, rearranges the math. And I think that's really, if you're looking for a lesson, and what the Fed has really taken from all of this is they're right now, the headline from a Financial Times piece that I quote in my article is, the Fed is in wait and see mode. And I think really if you're going to look at that, and so we're going to see a lot of debates, have we achieved the soft landing, right? And it's too soon to tell, I think would be the argument. We're maybe in softish.
We might be in softish territory.
Yeah.
Yeah, I should think so.
Yeah, but I would say, however, people are much more optimistic about the state of the economy and that possibility of kind of getting out without carnage,
right,
than they were 6 months ago, 8 months ago. Where if you look at and one of the things you do your year-end reviewing is everybody got 2023 wrong.
Yes.
Every equity forecaster was market's going to be down. Market's going to be down. And
was anything in our 2023 outlook wrong, or did we just nail it? Did we
I think it was 100% all the way.
Pretty
through.
sure we got it. Yeah.
100%.
Okay.
Right.
Just want to check. I think I talked about bonds last year.
Yeah.
Yeah.
And so I'm willing to accept. My one prediction was, if we look back at the kind of 1980s, I think we're in an era of more bond volatility than we were from basically 2012 to 2020, when things were pretty calm and easygoing in the global bond market, I think we will see more month-to-month fluctuation in bonds over the near term, because people right now, there's so much incentive to kind of guess with the Fed when they're going to do it, and people don't have the clear read necessarily, because the idea of the Fed just being in wait and see mode doesn't jive with what they're expecting, which is, they're saying, oh, we're kind of softish landing, right?
Yeah.
Let's wait and see.
Yep.
Whereas the market wants black or white. They don't love
Right.
gray. The market hates uncertainty, right?
Right. Because the one thing we absolutely knew is that inflation skyrocketed in the last couple of years. And we also know that it is scaling back, right? We're not in a deflationary environment, but disinflation, surely, right? And it's not at the point where the Fed would like it necessarily, but it's much more tolerable.
Well, and
for the general consumer.
Yeah, and one thing to keep in mind, there are a couple of different things. The Fed uses one set of numbers. We use consumers use a different set of numbers.
Yep.
And the Fed generally will look year over year or a 6-month period when they think about inflation. When you look at academic studies, people think of inflation as like 2 or 3 years. So we're still going into the grocery store and going, that box of cereal is more expensive than it was 2 years ago, by a great deal. But what the Fed is looking at, and the Fed looks at something called the PCE index, versus most of us think of the consumer price index, the CPI.
Headline inflation.
Yeah,
is kind
headline. And that's just the personal consumption expenditures index. And everything about that is saying it's pretty close to the 2-year target that the Fed has, the 2% target. And if they're there, they're in wait and see, because frequently we've seen, inflation ticks up again.
More data will come in.
Yep. And so, we're in that. I think softish might be the best at, and
yeah.
We made fun of it, because, well, what does that mean? Well, it only really means anything in retrospect, right?
Right.
We can only really say, that's softish.
Exactly.
But one of the final things that I want to make, points I want to make, is what may have paved the way for this is that everybody looked at the 1980s as their guide. And, a lot of economists of a certain age made their bones in the 1980s, right? And Paul Volcker is a hero because he kind of did this to bring down inflation. But the 1970s were a period where monetary policy was accommodative, as I mentioned, under Nixon. Yeah, we had deficit spending, but we had long-term inflation. Inflation had been going on for 8 years, right? And there are plenty of historical periods where, the blinder, could point to where we had more, and this is where you get in trouble, transitory inflation, right? Mm-hmm. And what everybody kind of misunderstood, and there's a piece last week in The Economist that talks about it, transitory for economists means something different than transitory means to you and I, right? Mm-hmm. We think of transitory as like a time period, inflation from, today to tomorrow. And, we think of transitory, short time, right? Well, for an economist, inflation, transitory means, is it caused by monetary policy or is it caused by external events, the supply shocks that you pointed to? And, there were a lot of indicators that until kind of the invasion of Ukraine by Russia, inflation, it hit a higher point, but it was starting to moderate. The numbers were starting to come back. There was some argument because we were actually in a brief period of deflation early on in the pandemic because everybody just tightened up. Mm-hmm. And as bad as inflation is, deflation is worse. If you take nothing else from this podcast, you don't want deflation. And so, but as soon as we saw that inflation, the economists who had come of age in the 1970s, 1980s, a bit like the man with a hammer, thinks everything is a nail, we're, okay, this is what's going to happen. And you can go back to other periods where we saw that, after World War II, you had inflation. why did you have inflation? Well, you had price controls. You had, huge amounts of military spending. You had all these people coming back, looking for homes, looking for refrigerators. And you had the supply wasn't up there because the economy hadn't transitioned from producing bombers to producing refrigerators. I just, on the plane, watched Ford versus Ferrari, the movie. And, Henry Ford II points out to his factory and said, hey, in World War II, we were building bombers there, and so they weren't building Fords,
Right.
So the idea that you shift and move resources, and the same thing happened during COVID. Remember when you couldn't buy patio furniture, bicycles, those sorts of things. So you saw these things come through. So I think, whenever you look at these issues, monetary policy plays a part, but as you said, there are other things, the kind of unknowns out there that you have to take into account. So I think the Fed is just kind of waiting. We may get another supply shock,
Right.
But so softish, wait and see. I guess we've been
softest wait and see, and we want a soft landing.
Yeah, yeah. None of us here is rooting for a recession.
No, and if a hard landing does occur, we've seen them before. We'll get through it at some point, right? I hope if that were to happen, right, then I hope it's not as deep as something like we saw during the financial crisis. There were a whole other slew of issues, in 08, 09, but you don't hope for that. But at the same time, we still could have a hard landing. It seems softish for now. Most people seem to be more confident, I think, where we are now, surely, than we have been over the last year or so.
Yeah. Yeah.
Which is encouraging.
Yeah.
So.
And I think, that's the case with and I hope that's what the Fed continues to do is, what do you do when the facts change? I change my mind, so wait and see. And if, we see continued worries about wage increases and wage inflation, that gets passed on to the consumer. So, yeah. But overall, softish isn't the most bullish sounding, idea.
I'm not here to make a bold prediction.
Yeah,
I don't know what everyone else's podcast is going to look like.
Yeah,
but,
constitutionally, I would say we're not too bold prediction guys.
No, I never have been. And maybe that's just the nature of what we do. It's like, hey, try to take a conservative approach sometimes. Try not to get yourself in a hole, by some bold claim. But, yeah.
But I think it's also, a lot of the time, you don't get on TV being boring.
Right.
And, a lot of what you hope for, right, is boring.
Right.
So softish approach from our perspective can limit the damage in a lot of cases.
For sure.
And so, hopefully, with Give Me Some Truth, you find us interesting, not boring, but we're not, trying to make the claim that's going to get headlines.
Exactly.
And
you can take boring and make it interesting sometimes.
Yeah. And so our goal really in kind of talking about this stuff is maybe to serve as a counterweight to, the screaming heads, 2 offices down that Stan has on the cable financial news network where, and that's the final thing that, we'll say. We're not unlike the people that you may hear on, the various financial news channels. A lot of times they have an agenda. They're talking about what their positions are in their mutual fund or hedge fund or what their bets are.
Right.
And that's what they're trying to push. We're not trying to push, we try to construct portfolios for our clients that are going to do the best over the long run within the kind of limitations of the market. But we're not pushing a short-term advantage or a perspective or a particular idea or a particular trade. When we have our investment committee meetings, it's what are the facts? So hopefully we gave you that a little bit today.
Yeah. And thank you all for joining us. We always enjoy being in the booth for Give Me Some Truth. Feel free to leave us some feedback. Check out the article for sure.
Hopefully the feedback isn't you guys are boring, but we did invite ourselves.
If that's the case,
yeah.
Hey,
Boring.
We
in a
can
good
live
way.
with that.
Boring in a good way.
We can live with that. So thanks again. Check out the Outlook, and we will talk to you all soon.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.
You gotta leave your money behind you. Raise your hand to the sky. Ask the masses for silence.